Hello, hello, and welcome to Personal Wealth Strategies' first webinar of the year. 2024 has arrived. 2023 definitely interesting from an investment standpoint of what occurred, and 2024 I'm sure will be just as exciting. And we've got the person here that will help educate us in terms of what happened in 2023, looking and dissecting that, but then also what to look forward to in 2024 and how we can work together to make sure that your investments are allocated properly so you could take advantage of all the things that the market will give us. So to introduce our speaker for today, it's Kevin Grogan. He is the Chief Investment Officer for Buckingham Wealth Partners, which is comprised of actually Buckingham Strategic Wealth, Buckingham Strategic Partners. So he's a pretty big dog. And while his job is like kind of all about the numbers, he enjoys collaborating with advisors like ourselves, clients like yourself, to really help all of us get educated. He's a member of the firm's investment policy committee, helping lead Buckingham's firm's investment strategy, portfolio management, and fixed income teams. He's the co-author of 3 books, most recently, Your Complete Guide to a Successful and Secure Retirement, which he co-wrote with Larry Swedroe, who we've also had on one of our previous podcasts. You can watch that recording on our YouTube page. And his first book being The Only Guide You'll Ever Need for the Right Financial Plan, also co-authored with Larry Swedroe and Tia Lim. So Kevin began his career at Buckingham in 2007. He holds his Bachelor's of Science in Finance from Missouri State University, MBA from St. Louis University. He's also a Chartered Financial Analyst, CFA, and Certified Financial Planner professional. So he's got all of that experience as well. It is my pleasure to introduce Kevin Grogan, and I've asked him to open up with a fun fact that I don't even know about yet. So Kevin, how are you doing today? And what is your fun fact?
Yeah, I'm doing great. Good to see you, and Happy New Year to you guys and to everyone attending today. So, in full disclosure, I had approximately 4 minutes warning that I needed a fun fact, but I was prompted by another example. So the one I'll give is actually from when I was a kid. Not just when I was a kid, but also now have family in Georgia, kind of rural Georgia, out sort of 2 hours outside of Atlanta. So one year in 1996, we went to the Olympics that year, and was actually kind of we weren't out this late, but in and around the area where the bombing happened, actually back in
Wow.
in 1996. So hopefully with 2024 being an Olympic year, hopefully those go off better than the one in Atlanta did. But that's kind of probably the most significant historical event I've actually been somewhat near to when it happened. But
Awesome. Well, thank you for that fun fact.
great. You want me to go ahead and launch in?
Yeah, why don't you share the
Okay.
screen, share the presentation, and then we'll launch in and start off with 2023 and then dive into what 2024 will hold. Because you can predict the markets, right? That's what we have you on here.
Yeah, no promises that I will be able to predict the markets, but I do think it'll be a good discussion about what happened last year now, but what happened in 2023, and also just some of the things that we're looking at heading into 2024. So let me go ahead and share the PowerPoint. Can you all see that?
Absolutely, definitely can.
Great. Okay, so let's go ahead and launch in. So 2023, if you kind of think back to what things were like a year ago, we were in an environment where most professional forecasters were predicting a recession in 2023. The vast majority of them back in 2023, and of course, that recession wound up not happening. We wound up not having a recession last year, despite lots of kind of negative events that occurred over the course of 2023. So you think back to the string of bank failures that we had back in early 2023 into the spring of 2023. Of course, we had Silicon Valley Bank fail, but we had a string of other bank failures that also happened last year. And it's kind of easy to forget, how challenging that environment was when we saw a string of banks fail. People were worried about their savings accounts, about their certificates of deposit, things like that. And then, of course, we had FDIC and other federal agencies stepping in to help kind of bail out some uninsured depositors in some of those banks. You think back to, we also are still kind of living through a stretch where we have conflict in the Middle East, specifically in the conflict between Israel and Palestine happening right now. And despite all of that, 2023 was actually a really solid year for stock markets and for markets more generally. And so as we go to this slide where you can see what happened across the various markets, it's when you have kind of green across all of these asset classes, that's a really good outcome for investors, where you had US stocks, international stocks, emerging market stocks, both nominal bonds and Treasury inflation protected securities, which are those tips at the end of the slide, all delivering positive returns over the course of 2023. So kind of to get to the punchline in advance, that means it's really good news for a diversified portfolio. If all of the underlying components are delivering positive returns, it winds up being a really nice year for diversified portfolios, which is what we saw over the course of 2023. Of course, in any year, you'll have some regions do better than others, and I'll touch more on that as we move through the presentation. But across the globe, the U.S. was the best performing market over the course of 2023. But I just kind of underline how it felt different at the time. As we were entering 2023, everyone was forecasting recession. As we moved into the middle of the year, we had the bank failures, and yet still a really solid year for market returns in 2023. Okay, so next we'll kind of dive into the different segments of the equity markets and how those performed over the course of the year. So this slide, again, a lot of these slides will have a good bit of data on them. So I'll kind of take my time and kind of walk through what you're seeing on each slide. So this slide has essentially kind of the 9 Morningstar style boxes for both US and international markets, and how did each of those segments perform. And the first thing I'd kind of call out, starting on the US side of the slide, is that if you have a year where the worst performing style box is still up 11.5%, that tells you it was a really good year for markets overall. So markets overall in the US, as we saw in the prior slide, returned about 26%, with large cap growth stocks performing by far the best of the 9 style boxes. And so there was and is lots of enthusiasm over the potential of artificial intelligence, and that led to a number of growth stocks really getting bid up over the course of 2023. And so that's really what you're seeing with the performance of large cap growth relative to the rest of those 9 style boxes in the US. But really, the story of the style boxes in 2023 is really a story of large cap doing better than small cap generally, but really more that growth did better than value over the course of 2023. Shifting over to the international side of the slide, you don't see as much dispersion in results. So the best performing segment was up 18.5%, worst performing segment was up 10.5%. But again, I would say that if you have a year where the worst performing style box is still up double digits, that's a really good year for stock markets. And again, a really good year for international markets overall, up about 17% over the course of 2023. So again, really good year for stock markets overall, but specifically for the US and specifically for large cap growth stocks. The next slide, it takes again, it's a bit more technical, but I'll kind of explain what you're seeing on the slide. one thing we know from looking at the academic evidence is that past performance isn't really indicative of what's likely to happen in the future. So knowing that growth did better than value last year, knowing that US did better than international last year, doesn't really tell you anything about what's likely to happen here in 2024. What's shown on the slide also isn't really indicative about what's likely to happen here in 2024. But what's shown on the slide is somewhat predictive of what might happen, say, over the next 10 years. And so what you're seeing on the slide is what's called current valuations, or what the current valuation level is of different segments of the market. And so kind of a simple way of thinking about valuations is that it's the price per dollar of earnings in this case for these different markets. So if you looked at the US market right now, you're paying $21 for $1 of earnings from companies that are based in the US, which is a bit higher than the long run historical average. And so what that tells us is that if the price earnings ratio right now is above its historical average, that you should expect a bit lower returns than the historical average for US stocks over the next 10 years. And again, it's not to say that that US stocks are doomed to crash or anything along those lines at all. It's just to say that return expectations should likely be a bit more muted from here moving forward than what we saw, say, over the last 10 years for the US market. But it's important to note that if you look at valuations, really the only of these four segments that's above its historical average are really US stocks. And what's not shown on the slide is even if you pulled out the seven most highly valued companies in the US, that looks a good bit more fairly valued or more in line with historical averages than what you're seeing with everything included in the mix. But if you look at, say, US small cap value stocks, those stocks are priced quite a bit below their long run historical averages. If you looked at international stocks, those are kind of roughly in line with long run historical averages. And then again, of course, international small cap value stocks are priced below their long run historical averages as well. So all this to say that if you said, okay, over the next 10 years, should you expect US and international stocks to outperform, we would say that there's a better than 50% chance that international will outperform the US over the next 10 years, but I can't tell you anything as certain as that it's 100% sure or even 80% sure. Maybe I'd say I'm 60% sure that international stocks will do better than the US over the next 10 years, simply due to these differences in valuation more than anything else. And so when folks say, why would I invest internationally? That seems a lot more risky than investing in the US. And the important thing to remember is that the market agrees with you. So the market is charging more for $1 of earnings from a US company than they are for $1 of earnings from an international company. And that's because the market perceives that international markets are riskier than US markets. So it's charging a bit lower price for that $1 of earnings from an international market company than it is a US market company. And we believe that risk and expected return are related. So that's why we would say you should expect a bit higher returns from international stocks than you should US stocks over the long run, say over the next 10 years. To be clear, this is not a prediction of what might happen, say, over the next year. We don't make predictions over very short-term horizons, but we do build out capital market assumptions that are used in planning software to help determine what the right asset allocation is for an individual client and when a client might be able to retire, how much can they spend in retirement. Answering those types of questions requires an input of what you might expect from stock and bond markets. And so that's how we use this type of information. Diving a little bit deeper into the US market, you can take a look at the different segments of the US market. So you can see the US market as a whole, but then also looking at those large growth stocks and small cap growth stocks relative to the value stocks. And just for context here, what's meant by value versus growth here is value stocks would be stocks that have low prices relative to their earnings or their book value, whereas growth stocks would be companies that have high prices relative to their earnings or their book value. And so again, what you see here is kind of a continuation of what we saw on the prior slide, which is that U.S. large cap growth stocks in particular have prices that are well above their historical averages, meaning that growth stocks are always kind of by definition going to be more expensive than value stocks, because that's kind of how we're sorting stocks into the different categories. But even relative to history, relative to its own history, large cap growth stocks are much, much more expensive than they are historically. So current price to earnings ratio on large cap growth stocks is 32. Historical average is closer to say 22 or 23. So large cap growth stocks now are much more expensive than they have been historically. And again, this isn't to say that the large cap growth stocks are doomed to crash by any stretch. It just says that, again, that we would expect lower returns going forward than what we might have experienced over the past 5 to 10 years from large cap growth stocks. Okay, moving out of stock markets and moving over to fixed income markets and interest rates. So starting off with performance. So what's interesting kind of about the performance in 2023 in fixed income markets is that for the most part, for most of the year, say call it for the first 3 quarters of the year, performance was roughly flat for most of these indexes. But over the course of the fourth quarter, and specifically in the month of December, we saw rates come down a good bit due to a kind of a pivot, or what's being described as a pivot from the Federal Reserve, coming out and being more forceful in saying that they are likely to cut interest rates this year. And so that led to interest rates coming down, which when that happens, the value of fixed income goes up. And you see some solidly positive returns really across fixed income markets this year. And so really no matter what your maturity was or what sector you were in, you were doing pretty well from a fixed income point of view, with credit doing better than other segments of the market. And that will tend to happen in years when the stock market does well. Corporate bonds will tend to do better than treasuries, and vice versa. So we tend to put more emphasis on treasuries because we want the fixed income side of the portfolio to really be there from a diversification perspective, and really help provide a ballast to the overall portfolio in environments when the stock market is performing poorly. Next, we'll take a look at interest rates. So here you'll see what the yield curve looked like a year ago, and then what it looks like roughly now. So the darker blue is what interest rates look like back at the end of 2022. And then the lighter blue is what they look like roughly now, or at the end of 2023. And what you'll notice is that this kind of masks a good bit of volatility that we actually did see within rates over the course of the year, but it kind of all wound up back where it started at the beginning. But I'll really kind of focus your attention on kind of the 0 to 10 year range, where you did see a little bit of a shift. So rates are actually a little bit lower now than they were a year ago once you get out past, call it 2 to 3 years. But short-term rates, which is really what the Federal Reserve primarily controls, are higher than what they were at the end of 2022. And so we have seen short-term rates move up. Longer end has come down a little bit. But for the most part, things look pretty similar to what they did back at the end of 2023. Next up, we'll take a look at what we're calling here projected inflation. And to be clear, these really aren't our projections. This is what the market is forecasting for future inflation. And the way you get to these numbers is you can look at what the yield is on a nominal treasury bond minus what the yield is on an inflation-protected treasury bond. And so these are bonds that are adjusted for inflation each year. And the difference between those two is essentially what the market is expecting for future inflation. And so from this is that really market expectations of future inflation have remained pretty well anchored in that 2 to 2.5% range, even as inflation spiked over the past 2 or 3 years. The market over the longer run, anyways, the market over the long run expected the Fed to get inflation under control. And indeed, we have seen some positive signs in that area, say over the last 6 months or so, with inflation not running as hot as it had over the prior, call it two plus years. And so market inflation expectations have actually come down a little bit over the course of the year, now kind of down in the lower twos as opposed to closer to 2.5%, which is where they were about a year ago. So the market is getting even more optimistic that the Fed will get inflation down closer to its long run 2% target. Okay, so next I'll kind of pull it all together in terms of what happened in 2023 and what it might look like for a 60-40 portfolio and kind of how that all comes together for an overall return. So I'll kind of start at the end of the maze and then kind of work my way back. But as I said at the beginning, it was a really good year for diversified portfolios. This kind of hypothetical mix of indexes in a 60-40 portfolio returned about 14% over the course of 2023. So that's a really, really solid year for diversified portfolios. But in terms of kind of how we got there, we picked up a couple of percent from fixed income. So 40% of the portfolio delivered about a little less than 2% if you add those two numbers together. As we saw earlier, the US market was by far the best performing area of the portfolio, and that kind of shines through in this attribution as well. With the 14% return, about 8% of that came from US large cap stocks, which to be fair is the biggest component of the equity portfolio, of that 60% equity portfolio, but still delivering 8% of the 14% return is impressive nonetheless. Small cap value stocks delivered another 1%. Shifting over to international markets, kind of in total delivered, call it around 3.5 to 4% of the return. So again, it really was the stock market doing most of the work on that 14% return, but bonds also, again, contributed this year. And again, what's really nice about the performance this year is that none of these bars were into negative territory. It's kind of detracting from returns. Really, everything was kind of working together and contributing towards that 14% return. All right, now let's go ahead and move into what we're looking at for 2024, and then of course can open to questions at the end. So I'll really hit 4 different topics. So we'll talk about what the projections look like for interest rates in 2024, what we should expect from stocks, and I've already touched on number 3 a little bit, but we'll provide a little bit more content on what should we expect on U.S. versus international. And then lastly, everyone's favorite topic, I am reminded that Iowa caucuses will be here in a couple of weeks, that we have an election this year. And so how you should be thinking about that here in 2024 as it relates to your portfolio. Okay, so in terms of interest rates, so the Fed has projected 3 0.25% cuts, or 25 basis point cuts in the Fed funds rate, while the market has priced in 6 25 basis point or 0.25% rate cuts this year. And so while that obviously there is a disconnect there, kind of one way to kind of interpret that is that the market believes that the economic data will be worse than what the Fed is expecting, and that the Fed will wind up needing to cut more than what they are currently projecting this year. So that would be one kind of interpretation of these rate cuts, is that the market is expecting worse economic data than what the Fed is. But big picture, I would say that it's in general good news that we're at a spot now where the Fed can contemplate cutting rates, because the inflation picture has improved at least somewhat over the past 6 months. Now we'll see what happens, say, over the next 3 months. You know, if the Fed actually can start cutting rates, say at the March meeting, Then by that point, they would have, call it 8-9 months of cooling inflation data to go off of to potentially start moving interest rates down at least a little bit over the course of 2024. Important to note, though, that the market is not expecting a return to the ultra low interest rate levels that we saw back in the 2010s. So even though the market is expecting more cuts than what the Fed is projecting, the market over the next 3 to 5 years is not expecting short-term interest rates to go down all the way down to 1 or below 1, which is what we had really for 10 plus years in the 2010s. And so I think for savers, for borrowers, it's important to know that to not expect rates to get back as low as they were in the 2010s. At least that's not what the market is expecting. The kind of takeaways here is that if you are a borrower, higher rates are in general bad. So if you're looking to take out a new mortgage or finance a car purchase, things like that, higher interest rates is generally bad news. But for many of our clients who are at this point retired, are generally more savers, the higher interest rates is actually really, really good news for those investors, because now you can actually earn a respectable return on the safe portion of your portfolio, which really wasn't possible for most of the 2010s. You can actually earn a decent return on, again, if it's a hypothetical 60-40 portfolio, that 40% that's in fixed income is now actually working for you when it really wasn't for most of the 2010s, except serving as kind of safe money to protect against stock market declines. Okay, in terms of stocks, as I've been saying all along, we don't really do short-term forecasts, and that's really because they are notoriously unreliable. Again, we saw a year ago, the vast majority of professional forecasters were expecting a recession in 2023. That wound up not happening. We wound up having a really good year for the stock market, and even economic growth was really strong for most of 2023. As I shared earlier, U.S. valuations are high relative to history, which indicates a lower forward-looking expected return over the longer term. Though, again, it's important to build that in to the planning that you're doing, but I would not use this information to try to time markets by any stretch. 2024 could very well be a very good year for the U.S. stock market. Indeed, it could outperform international markets again, which again, I'll touch on more here in a second. As I shared, U.S. outperformed international this year. That actually was a reversal, though, from 2022. In 2022, both U.S. and international markets were down, but U.S. markets were down a good bit more than international in 2022. And so a common question we get, again, is why should I continue to stick with international stocks, given that it's been a long time since they've outperformed on a consistent basis? And indeed, it's true. In the 2010s, U.S. outperformed international by about 8% over that period of time, and we've seen that continue here in the 2020s. But you don't really have to go back all that far to find a period where international outperformed, and that was really just in the 2000s. So over that stretch of time, U.S. stocks actually delivered negative returns, so about 1% per year returns over the course of the 2000s. And what's nice about having been in this business for a little while now, I can remember back to what it felt like in 2010, having clients ask about why do we have so much invested in the U.S. when it's underperformed by so much over the past 10 years. And now we're just kind of seeing that in reverse here in the early 2020s. And so there's of course, no guarantee that international stocks will do better than U.S. stocks over the decade of the 2020s. But it's important to note that we just have no idea which area of the market will wind up outperforming in the future. So we think it makes sense to own both in meaningful proportions. And so that's what we would advise investors to do for the coming 10 years, looking at this pattern and not really being able to discern any pattern that you can really use to time the market. We just know that these things will move in cycles, and it's impossible to predict which area or which region will wind up doing better in the future. Okay, save the last topic, the most controversial topic for last, which is the election. And I won't really get into who you should vote for, or anything along those lines. But one of the more common questions that I'll get as it relates to politics, elections, and markets is, well, which party, does the market do better when Republicans have the White House or when Democrats have the White House? And so to disappoint fans of either party, there's really no difference, honestly. No matter which party controls the White House, there's no statistically significant difference as to what the market will do under Republicans versus Democrats. The performance is roughly similar, and certainly there's no statistically significant difference. Now, with that said, there is a difference in how individual investors perform depending upon their politics and depending upon who is in the White House. And that might be a little bit counterintuitive. And really that the reason, though, has nothing to do with the actual policies that each party might put into place. It has to do with investor behavior. So if there is really strong academic evidence showing that when your party is in the White House, you're much more likely to stay disciplined in your long-term plan. You're less likely to sell out of stocks at the first sign of bad news. And you're just, again, much more disciplined as an investor. So you are more likely to outperform when your party is in power because of your own behavior, not because of what that party is actually doing with their policies. It all has to do with your own behavior. And unfortunately, the same is true vice versa. When your party is not in power, you start to get panicked and distressed at the first sign of bad news, and you are sure that that's going to spell doom for markets. Whatever party you don't favor being in power is likely to spell doom for your portfolio and for markets more generally. But it turns out that over the long run, again, stocks tend to do well. They tend to deliver positive returns over the long run. So your best bet is simply staying disciplined to your long-term plan. And by the way, again, I've seen this happen for both parties. I've had lots of clients back in 2016 who were sure that Donald Trump would be the end of markets, and of course, markets did really well for most of his presidency. Same thing when Biden got elected in 2020. Had many clients who said they were sure that it was going to tank markets. Markets have been really solid for the most part over the last 3+ years. And so again, there's no really using politics to predict markets, but really the main thing you should focus on is really staying disciplined to your own long-term plan, no matter who's in the White House, no matter the outcome of the election coming up here in November. So with that, I will pause and see if there's any questions.
Awesome. Thank you so much for that, Kevin. If any of the attendees has any questions, feel free to put them in the Q&A feature in the chat. I do have a question as well, because I recently heard that U.S. companies are obviously, the large companies are very highly valued right now. Obviously, there's a lot of tech from the AI boom that's helping them. It also tends to be the larger companies as well. And those larger companies also had the ability, when interest rates were low, to lock in very attractive long-term debt at lower interest rates. Whereas some of the smaller companies didn't have that luxury, and most of the smaller companies have some variable interest rates, and as interest rates have risen, that kind of crunches their cash flow. And as smaller companies tend to be less profitable than larger companies, that may hurt smaller companies' returns going into the future. Do you have an idea about that, or any comment about that?
Yeah, so I think everything you said there is directionally correct. The one thing I would tack on is that markets react incredibly quickly to new information. So as interest rates started moving up, really, back in 2022, we saw small caps underperform large caps as interest rates started moving up. So these things kind of have already moved in tandem and have kind of already been baked into the prices that you see today. And again, that's probably part of the reason. A lot of the things that you mentioned are probably part of the reason why U.S. large caps are at such higher valuations than small caps are. So you're already paying a lower price per dollar of earnings for a small cap company than you are a larger cap company, and that's the market's recognition that yes, small cap stocks are a riskier bet. than large cap stocks right now. So we're going to charge you a lower price per dollar of earnings. And so if risk and expected return are related, that would tell you that small caps should have higher expected returns over the long run than large caps would. But one other, only other thing I would tack on too is you are right that a lot of the large and mid cap companies did take out fixed rate debt, but of course that eventually rolls off as well, and that will continue to roll off over the next 2 to 3 years. But that is at least part of the reason why people think that that the Fed adjusting interest rates higher hasn't really slowed down the economy all that much, is that you do have a good number of players, both corporations with kind of long run fixed rate debt and consumers. If you think about everyone who already owned a home going into 2022, if they had a mortgage, most likely it was in the threes or even lower potentially. And so interest rates moving up a good bit really has no effect on your own mortgage payment if you locked in, at super low rates. Now, of course, it might affect you negatively in other ways. You might be less likely to upgrade your home and move into a bigger home. And so that kind of indirectly does slow things down on the economy, but it doesn't slow down your spending on other things. You can still, take all the trips, go to the Eras tour, whatever you might want to do with your excess spending. You can still go ahead and do that and bid up prices in other areas of the economy.
You are correct. I'm very happy with my 3.125% mortgage, and I'm not getting rid of that anytime soon.
Right, I'm right there with you.
And absolutely, when you go back to the large versus small, if you even look at the differential of the price to earnings that we were looking at on one of those charts, where the large growth was at 31, way above its historical average, and the small value was at like 9 or something, way below its historical average. So it's trading with those risks present, and so that information actually says probably they're at a relatively low value now in terms of small companies. Maintaining those in the portfolio in proper allocations, maintaining that diversification, you should get rewarded for it as a long-term investor. Now, if you're trying to make short-term plays, that's not what we do here at Personal Wealth Strategies. Not what you do at Buckingham, and so we're not going to comment on that. But over the long term, having that small allocation, that small value allocation even, should help enhance the returns long term, especially now when those price to earnings ratios and price to book are relatively low levels compared to historical averages.
Absolutely, yeah.
Now
Kevin,
we are on.
Sorry,
David,
I was going to jump in here. One of the slides that I've seen you present in the past is the idea that companies grow rapidly when they're becoming a top 10 company, but once they become a top 10 company, they tend not to grow at the same pace. And yet investors oftentimes fall in love with those big companies and assume they never can fail. And I'm wondering if we're not at a point right now when we look at those big companies that have grown so much, is there reason to believe that will still hold true?
Yeah, so I think that is for sure true, that typically if once you get to be a top 5, top 10 company, you tend not to stay there forever. And of course, always the most dangerous phrase in investing is "this time is different." So you will often hear that. Well, Amazon is different, Tesla is different, whoever it might be that you're talking about, that it's at a very high current valuation. One of the possible explanations for why there historically has been a premium or an expected excess return for investing in value stocks is that part of it could just be behavioral, that systematically investors tend to over extrapolate what's gone well over the past 5 years and what's gone poorly over the past 5 years, meaning that they bid up the prices of the outperforming companies too much and they beat down the prices of the underperforming companies too much. And that could be, and likely is, a part of the explanation for why historically these lower price to earnings ratio or price to book ratio companies have outperformed the higher price to earnings ratio and higher price to book ratio companies. And again, it's impossible to predict what will happen over the short term, but I think it's reasonably likely that the biggest companies of today, whether it's Apple or Amazon, may not be 20 years from now. You think back, 20 years ago, one of the biggest companies was GE, as an example. That's now a much, much smaller company. And again, it's sort of hard to remember what that was like, but you think back 20 years ago, this was, again, pre 9/11. it was, well, I guess, a little more than 20 years ago. I'm going back to 2000 with this, but you had GE, had NBC, it was a huge conglomerate. It was one of the biggest and most admired companies in the world, and now it's a shell of its former self. And again, who's to say what will happen 10, 20 years ago? We don't know. So we would say just own everything. But if you're going to incorporate a tilt or an overweight, you should tilt or overweight to those lower priced companies, because historically those have outperformed over the long run.
Great context and example there. Kind of along that same path, because one of the kind of oversimplistic ways to invest is to just say, invest in the S&P 500 and that's it. And if you did that, that worked out because you're earning the 26% rate of return or whatever, and did better than most anything else that you could have purchased, at least in 2023. And like you said at the beginning, just because it worked out in the past doesn't mean it worked out in the future. But one of the risks of the S&P 500 is that market cap weighting, with those larger companies getting a larger piece of the pie. Do you have any comment on that, just of somebody that says, you don't need all this different stuff, just invest in the S&P 500 at the very lowest cost, and then that's all you need?
So the first thing I would say, I always try to look for the good in things. There's way worse things you could do, right, than just investing in a low cost index fund, even if it's just U.S. large cap stocks. If you just bought and hold that, and you did that for your whole saving and retirement, there's way worse things you could do. Specifically, what we see a lot is just investors kind of getting in their own way and trying to time markets, or again, getting panicked and trying to sell at the first note of bad news and things like that. And that winds up really hurting your returns more than any of this other stuff that we're talking about. But I think you can do better though than just investing in the 500 largest U.S. companies. And that's by incorporating things that will help diversify that, like investing in U.S. small caps, and then diversifying a step further into international markets as well. And so, again, we have no idea which area of the market will wind up doing the best going forward. So we just want to own a bit of everything and not stay concentrated in just U.S. large cap stocks, because it's often said that diversification is really the only free lunch in investing, where you can reduce your risk without really sacrificing much in the way of long-term returns. And so by owning not just U.S. stocks, but not just U.S. large cap stocks, but also small and also international emerging markets, things like that, you can better diversify your portfolio. And while we all, I think we all believe that the U.S. is great and is likely to do great going forward, and I certainly do believe that. I'm not 100% sure that the U.S. will do great, say, over the next 10 years. And again, it's impossible to know in advance, and so why not own a little bit of everything, own some international stocks to help balance that out in case the U.S. does underperform international over the next 10 years. Of course, again, even within our portfolios, we incorporate an overweight relative to market cap weights to U.S. stocks. And so, but it's just a matter of how much overweight do you want to have. And I think having 0% invested internationally is not the right answer. Having some meaningful amount, call it 20, 30, 40% international, I think is a reasonable thing to do. And there are markets that can go through 10, 20-year stretches of time where they deliver negative returns. The U.S. went through a 10-year stretch, as I shared, in the 2000s, where it delivered negative returns. Japan went through a 20-year stretch where it delivered negative returns over a full 20-year period of time. Do I think that's likely to happen in the U.S.? Absolutely not. I don't think it's likely. Is it possible? I mean, the historical experience says that it's possible. Is it, again, to put an odds on it, is it a 5-10% chance? Probably somewhere in that ballpark, that the U.S. delivers negative returns over the next 10 to 20 years. But if you're all in the U.S., you're not really well protected against that 5 to 10% chance outcome, which is what we want to protect against, because of course you only have one shot at retirement. So if you get a bad outcome or a bad draw and you happen to retire at a point in time when the U.S. is about to go through its really bad stretch, being all invested in U.S. stocks at that point in time is a catastrophic outcome for that retiree.
Amazing. Speaking of diversification, something completely outside the realm of what we invest in currently, But it looks like the SEC is on the verge of a Bitcoin ETF approval. What are your thoughts on that? And what are your thoughts on cryptocurrencies in general as a diversifier for a portfolio?
So I'll start with the wonky stuff first. So in the SEC approval, I think makes sense to approve a Bitcoin ETF, and only because it has already approved products that allow you to buy Bitcoin futures, which are essentially a derivative of Bitcoin. So I don't, again, just from a logical consistency point of view, I just don't see how that fits. How you can approve the derivative of an investment, but say the investment itself isn't approved for an ETF. So I think, yeah, approving Bitcoin ETFs probably makes sense, again, from a logical consistency point of view. And also, I think it just makes it more accessible to investors. Now, the question of should you allocate to Bitcoin? And really what I would say on the question of should you allocate to any asset class, what I'd really start from is what's the market cap of that asset class. So just starting with kind of how we think about US versus developed international versus emerging markets. If you looked at how the world allocates capital right now, it'd probably be something like 50%, I'll call it 55% US, 45% ex-US. Again, our portfolios typically will be in that 60-40 or 70-30 range. So a slight tilt towards the US equities, but still having a meaningful amount invested internationally, because we want to be relatively close to the way the world is allocating capital, at least from a theoretical point of view. If you use that same framework with Bitcoin, you looked at all of the global market cap in dollar terms of Bitcoin, it represents about a little less than 1%, or call it 0.5% of global capital, of globally traded securities. So if you started from that basis, you would say, you couldn't really justify more than a 1% allocation to something like Bitcoin. We would say, if that's all it represents in terms of world markets, it's okay to exclude it altogether. So there's a classification of international markets called frontier markets. These would be kind of a step below emerging market countries. And those represent, again, kind of about 0.5% of the way the world allocates capital. So we just kind of exclude it altogether. We say it rounds down to zero, no need to include it in the portfolio. We would kind of say the same thing about Bitcoin, that it's not a huge player, at least at the moment, in terms of the way the world allocates capital. So there's no real need to incorporate it into a portfolio. The other perspectives I'd share in terms of justifications people often have for including Bitcoin in a portfolio is that they say that it's like digital gold is one of the justifications. And I think that people who say that are probably right, in the sense that people think that gold is a hedge against inflation, but it isn't. People think Bitcoin is a hedge against inflation, but it really isn't. And we saw that over the last couple of years when we saw a huge spike in inflation, and Bitcoin had its worst stretch, or among its worst stretches ever over that stretch of time. So I don't think it really makes sense to include in a portfolio, at least at this point in time. But if you are going to include it, I would say limit your exposure to say 1% or less of your portfolio, and be prepared for very, very high volatility, higher volatility than you've ever really experienced in any of your kind of traditional assets like stocks and bonds. It's on a whole other level in terms of how much volatility you might see in Bitcoin, although that has come down a good bit here lately, but who knows what the future might hold. And the other thing I would say too, that's sort of a risk that's difficult to price with respect to Bitcoin, is potential future regulation. If the SEC comes in and changes, like let's say they approve an ETF, they could always change their mind in the future if you get a different administration that has a different opinion on these types of products and Bitcoin as an investment or as a security and those types of things.
Yeah, no, definitely. I love all of that context that you said there, and we're on the same page from the the ETF approval standpoint. I think it would make no sense not to approve it. And I think them dragging their feet has actually hurt investors, not helped investors. I think at the end of the day, that's what the SEC is trying to do, is maintain the investor safety and what they're investing in. And And by not approving an ETF vehicle, they've left the investors to go who are hungry for this asset to go on their own and then get into ties up with what happened with FTX and the shady practices that went down there and causing the loss of their assets. And so I think one, an ETF makes sense, and then two, exactly what you had said. If you are going to invest into it, one, our firm stance, we don't invest in Bitcoin as you said, but it is a growing asset, a valid asset, newer technology, and people do get excited about new. And so if you are going to invest in the space, keeping it around less than 1% of your overall portfolio, and having it and recognizing that one, it could go to zero, and two, if it doesn't, it's going to have tremendous volatility like it has in the past. And if you can accept all of that, then including it as a part of your overall world, I don't believe is a bad idea for sure as a further diversifier. Awesome, David. Any final from you, or you can close us out?
All right. So first of all, Kevin, thank you so much for joining us today. That was really informative and really good material that you presented. So we greatly appreciate that. I want to make sure that our listeners are aware that the education never stops here at Personal Wealth Strategies, and that we always have the next program lined up for you. And the next program is actually tonight, where we're doing the second workshop as part of our Family Love Letter program. And if you are interested in joining us tonight, we will have an attorney, Carly Beauvais, who's going to be presenting. If you have questions about wills, trust, and how to use one versus the other, and what are state regulations, and all different types of questions around estate planning, Carly is the person to be asking. So please do join us tonight. And if you need a link to that or the registration, if you need to go to the registration to get the link, let us know, and someone on our team can get that to you. Our next monthly webinar will be in February and continue throughout 2024. You can mark your calendar now, is that we always do hold these webinars at noon on the first Wednesday of the month. So we will see you in February and each month beyond.
Yes,
So
and if you're watching this on the replay, tonight is not helpful for the Family Love Letter, but do not fear, because we do have resources. If you're interested in getting some help with, getting all of your information in order, setting up your estate plan, looking at making sure that everything is in alignment, we do have those resources. So reach out to us at the information that you'll see below this video, and we'll be able to get you some of those resources for the Family Love Letter. I'm sure we'll be holding future workshops and sessions on that, because it has been quite a valuable program for our clients and those that have attended the sessions.
And along those lines, Justin, if you see us right now, you may be watching us on YouTube on a replay, but we do have a YouTube channel where all of our past monthly webinars are recorded and have been posted. So feel free to go through the channel. There's been a lot of great material in 2023. There'll be a lot of great material in 2024, and please go through it and use us as a source for any follow-up questions that you might have.
Awesome.
Amazing. Kevin, any final from you?
Yeah, last thing, of course, great to be with everyone here today. And if you're watching on the recording as well, hope you have a great 2024. And of course, if you do have questions, Justin and David will be great to answer them, and I'm happy to connect with you via them as well.
Amazing. Thank you, Kevin. Have a great 2024, everyone, and look forward to a great year.